Hello folks, welcome to another edition of the Market Pulse Market Update. Oh, there's so much going on right now. Not sure what to cover or what to tell you. Wish I had a more positive story about the precious metals, but anyway, let's just jump right in. There's been a lot of ink spilled in the last week about this chart. This is the quarterly report. Bank trading derivative activities comes from the Comptroller of Currency. Of course, that's one of the arms of our government. And let me get back to the chart. What we are seeing here is the level of derivatives in the precious metals markets, gold and silver in particular. And just a massive spike in the first quarter of 2022. Now there's like I said, there's been a lot of ink spilled on this chart. I've watched a couple of videos, people with far more knowledge than I do about the derivative markets, what their take is on this chart. And what I get, the sense I get is that the BIS is aware that we are headed into a liquidity crisis, similar to 2008. And they're trying to head off the collapse of, or they don't want to be blindsided by the collapse of a major bank like JPM, Bank of America, Chase, etc. You know, in 2008 it was Lehman, which is big enough, but a collapse of something like a JPM, obviously that would that would be a market killer. And so anyway, the BIS forced they changed the way the banks have to show their derivative positions on their books. And so this is basically, it's JPM coming clean about the derivatives that they hold in the silver and gold markets. Just massive. And so, you know, I hate to say that the markets are manipulated, because a lot of people, they immediately, you know, it's like, oh no, the markets aren't manipulated. Why are you saying that? You don't know anything. It's like, well, you know, I hate to be unkind to people, but if you don't think the markets are manipulated, you're being naive, frankly. You know, let's talk about market manipulation. I mean, in 1971, Nixon closed the gold window. Do you not think that was a manipulation? I mean, for 3 decades, Bretton Woods agreement, the whole world agreed, okay, this is the value of the dollar, it's backed by gold, etc. Nixon comes along in 1971, closes the gold window. Basically, you know, thumbed his nose at the rest of the world and said, yeah, no, we ain't gonna play by those rules anymore. Is that not a manipulation? And then London Gold Pool, it failed in 1968. You know, if you don't, that was another major manipulation of the gold markets. Go look it up, do some research. Exchange Stabilization Fund. This is another branch of our government. They have a budget of, it's about $600 billion. They're only required to report what they're up to on an annual basis. And so their latest report was for 2020. We have no idea what they did in 2021, much less what they're up to in 2022. But that's another arm of our government. They got $600 billion to play with, and they're out there, quote unquote, stabilizing the markets. You know, take that for what it's worth. And then, of course, we have the plunge protection team. That's that's what the market calls them. The official name is it's the President's Working Group on, I'm drawing a blank on it. But anyway, look that one up, plunge protection team. Obviously, they are out there, you know, maybe you're not comfortable with the word manipulation. They are taking active positions in the financial markets, and it ain't for the good of you and I, although that's what their mission would claim. Derivative markets, obviously, they're huge at this point. We just looked at this chart. That's just silver and gold. That's only silver and gold. And the similar kind of stuff happening in all of the markets. Any market you want to talk about, certainly the stock markets, there are derivative positions that influence and, push those markets in whatever direction the big market players, the central banks, the big banks like JPM, et cetera, the derivative markets push the financial markets in whatever direction they want them to go in. Then we have the trading desk at the Federal Reserve. This is another, they're out there actively, open market operations is what they call it, but they're actively taking positions in the financial markets to accomplish whatever it is they think needs to be accomplished. And again, not necessarily for the good of you and I. And so anyway, if you don't think that the markets are manipulated, you're kidding yourself, in my opinion. Just go do some research. Let's look at some charts before I get too worked up. This is gold in the weekly time frame. Unfortunately, I don't think gold is done dropping. If we look at this horizontal support resistance level, that's 1680. So I suspect we're going to see 1680 in gold. We drop down to the daily time frame, potential bounce. You can see that gold has reached this, this is the first median line extension of this shift pitchfork, and we're getting a little bounce from that support level. But MACD in bear mode, and based on the histogram, continuing to push lower. So no indication here that this is likely to be a bottom, other than we are getting a bounce right now. And I say bounce based on the lower wick on that candle. So we can see that price reached down towards that first median line extension and then pulled back a little bit. That's another daily, just a daily. This is the gold chart from TradingView versus this is the gold futures market. So again, getting a bounce off of this. In this case, we're looking at a modified shift pitchfork bouncing off that support level. But again, MACD doesn't look like it's bottoming. Energy is very low. Now this chart is interesting to me. So in the upper frame, we have in the monthly time frame, this is gold as we normally look at it. And then in the lower frame, this is gold deflated by the CPI, and it's the all items CPI. So it includes both energy and food. And notice the difference in particular for the last 2 years. So 2020, there's 2 years, 2020, there's 2 years. Look at the difference in these two structures. So if we just look at the dollar chart, gold versus the dollar, basically, that's what we're looking at here. We could call this a sideways consolidation trading range, however you want to think of that chart structure. But look at it when we deflate it by inflation. So inflation in the last 2 years has been so massive that it takes this sideways range and tilts it down. What I'm expecting to see is that in this deflated chart, gold is going to come all the way down to, it was the bottom of the big scary plunge back in 2020, and it's also a horizontal support resistance level or zone. So we can see, there's support, drop below, resistance, support, resistance, resistance, multiple times where we got resistance, and then found it as support again, and then, off to the races. I suspect before gold is done, we're going to see gold down at this level, which again, equivalent to the bottom of the big scary plunge. It was interesting to see yesterday when the CPI was updated, the deflated chart made a noticeable move to the downside. And one of the one of the things going on in my head these days is that with everything that's going on in the market, we can't, or we're fooling ourselves to think that the dollar is stable. The dollar is not stable at this point. Our purchasing power is eroding rapidly, daily, weekly, however you want to think about it. The purchasing power of all of the fiat currencies are rapidly eroding right now. And so we need to take that into account when we are looking at financial charts. You know, for years it's been fine. The 2% inflation that, you know, that was the Fed's target for so long. You know, okay, we got away with looking at charts, making predictions, forecasts based on the regular chart, you know, gold versus the dollar. We're in a new market, in my opinion, where we have to start thinking about, okay, today the dollar is worth less than it was yesterday. How does that affect my positions, my investing? And so I'll stop babbling about this chart. But anyway, I'm expecting the gold to continue lower. Hopefully when we reach this level, it will find support and turn back up. And again, this is the same level we reached back in the 2020 plunge. Sigh. And so let's go. So this is silver in the monthly time frame. Again, this is silver versus, one last point. Because the BLS, Bureau of Labor and Statistics, because they apply so many adjustments to the inflation numbers, the CPI, there are at least 8 adjustments. I won't bother naming them, but 8 adjustments that are made to the inflation rate before the BLS publishes the official number. And of course, that's why when we look at the CPI, it was just announced as 9.1%. And then we go look at John Williams' work, and he's showing inflation almost double that. I think we're currently pushing 17% based on his work. So what I've done in this chart is I've actually doubled. So you can see right there, CPI times 2. And so I've actually doubled the CPI to get a more accurate, in my opinion, a more accurate read on inflation rate. So in this chart, we're deflating by 2 times the CPI. So silver in the monthly, silver versus the dollar, potentially at a support level. Same as gold, I don't really expect us to hold at this point. I suspect silver is going to head lower from here. No, you know, MACD, nothing in MACD looks like a bottom. Stochastics are energy very low. If we drop down to the weekly level, excuse me, same thing, energy low, MACD heading lower. We potentially had support at the round number. You know, round numbers act as support and resistance. We can see it acted as resistance back here, and then so far has failed as support. So we're not seeing the round number at 19 acting as support. Based on Andrew's pitchforks, the next potential support level or the next price target is at this median line, that's $17. So take another $1.50 off the price of silver, unfortunately. Here in the daily time frame, we can see that the median line of this Andrew's pitchfork has been acting as support. Potentially, we're getting a bounce off of that level, you know, based on the wick, the lower wick on that candle. Again, MACD, based on the histogram, is, you know, it was looking like maybe we're getting a bottom, but now it's heading lower again. Energy very low. This is the same. This is the price of silver deflated by 2 times the CPI, all items CPI. And again, we're not at a support level in the deflated chart. We are at support in the silver versus the dollar. But if we focus on silver deflated, we've got a ways to go yet. Here was the big scary plunge in 2020. And if we zoom out, we can see that this level has acted as, here it was support, 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 resistance, a little bit, support, numerous times where it's acted as support. And so anyway, I suspect in the silver, we're going to see price drop down to, at least this level before it finds potentially finds a bottom and heads back higher. I hope I'm wrong. Let me be the first to say I hope that I am wrong, but I am steeling myself and suggesting that you do likewise. We are likely to see lower prices in the precious metals, which of course means that the mining stocks are going to head lower as well. Here we are. This is the monthly time frame GDXJ, potentially sitting on a support level. We can see this is a pretty nice looking price channel. Support and resistance back here, resistance again, support, support. We're at that level where that could be support. I mean, I'd love to see the mining stocks turn up from this level. I don't think they will. Here's MACD in bear mode. No hinting at a bottom in MACD. Energy is very low. Weekly time frame, we're not at a support level yet in the weekly time frame. This would be the lower median line of this modified shift pitchfork. It's still, it's, what is that? Call it 27. So we're at almost 30, 27. What's that? 10%? Another 10% lower. So anyway, I expect mining stocks are heading lower. We can see MACD. MACD is reaching a very oversold level. Let's back up, we can see, we bounced off of this level of oversoldness, dropped into it. We're there now, and we're actually pushing through the bottom of it. So MACD is not a bounded indicator, but it oftentimes, prior lows and highs will mark the range, the end of a price movement. And we can see that here. So, if we look at that as a low, well, it was the low again, and, maybe it'll be the low this time as well, or almost the low. But there are no other indications to suggest that that will be the case. Energy very low based on stochastics. We drop down to the daily time frame. And again, price has been, beating against the 20-day moving average on the upside. Median line of this shift pitchfork, also acting as resistance. MACD is a little bit more encouraging, at least in the daily time frame. Maybe trying to bottom for a little bit of a counter trend rally. This candlestick today, that's certainly encouraging. That's a bullish candlestick. Maybe we get a little bounce. I thought we were getting a bounce starting yesterday, but obviously weakness in the metals took the mining stocks out today. So big drop today. What are we at? 4.3%. If we look at this is GDXJ, again, monthly time frame and deflated by twice the CPI. Again, based on the deflated chart, we're not at, well, we were at a level that we might have expected to see a bounce or some support. That would be this level, excuse me. But notice that we've now dropped below it. So support has become resistance. We've still got two weeks left in this month. So we could get a bounce to the upside, and this candlestick, that would turn into a long lower wick with a body above this horizontal level. I suspect it's more likely that this chart will continue lower, And our next support level is down here. Again, this was the low of the big scary plunge, and this was the bottom back in late 2015 was the bottom of the last bull market in the metals and the mining stocks. And then we got a sharp rally in 2016. But so anyway, that's the next support level in the deflated chart. And it's not going to surprise me to see GDXJ reach that level. This is the Gold Miners Bullish Percent Index. It is a reading on sentiment within the mining stocks. Obviously, sentiment sucks. There are very few bulls left in the mining stocks at this point. We're at a 10. We got down to 0. This was, again, big scary plunge, March of 2020. Back in 2008, in the depths of the great financial crisis, which is a silly name, but anyway, that's how that 2008 period is referred to. We also reached 0 in BPGDM, and it's not going to surprise me to see 0 again before we get a turnaround. I guess the positive side of that is we're almost there. We don't have much further to fall before we get potentially get a bottom in the mining stocks. And while I'm talking mining stocks, in my opinion, the game or the successful strategies in the mining stock world have dramatically changed. I don't know whether the mining stock sector or the mining companies have accepted that or changed their plans based on that. But in my opinion, the game has completely changed in the world of mining stocks. We recently saw Alexco just sold out to Hecla. And I would point at that as an example of the game has changed for the junior miners. It made more sense for Alexco to sell out to Hecla than it did for them to continue trudging ahead. And then again, for us as investors, it was already clear to Alexco that they were going to have to dilute the shares. They were going to have to sell shares to raise more money to continue operations. And so I think we will see more of that. Some of the juniors who today might tell you, oh yeah, we're going to build a mill and we're going to become a producing miner, I suspect that they will change, will be forced to change if they don't do it on their own volition. They'll either have to adopt a toll mining, T-O-L-L, toll mining business model where they mine their ore and then truck it, transport it somehow to an existing mill, because the cost of building a mill is just prohibitive. Or if they remain stubborn and insist on building a mill, they're going to have to dilute the shares so badly that we won't want to be invested with them anyway. So again, in my opinion, the game has changed. And of course, with the toll business model, as soon as you start talking about, okay, I'm going to mine my ore, I'm using diesel fuel to mine my ore, lots of it, and now I'm going to put my ore on a truck and I'm going to drive it somewhere. I'm burning more diesel fuel if it's available. And so again, even the toll mining business model has changed because of the dramatic changes in the cost of energy, the cost of diesel fuel in this case. So I suspect we will see a lot of changes in the junior mining space. The follow-on thought to that is that the most attractive business model in the mining space, in my opinion at this point, is the royalty companies and the streamers. Think about it. So a streamer, they loan a mining company, $30 million, whatever the number is, and in return, the mining company agrees to give them, 10,000 ounces of gold a year, or 2% of their gold production a year, whatever it is. The streamer is well, they are affected by the price of diesel, but not directly. The price of diesel affects the mining company directly. They got to buy the diesel. The streamer, they're going to get 2% of that miner's output. They're only indirectly affected by the rising cost of diesel fuel. And so anyway, in my mind at this point, the most attractive business model in the mining stocks is the royalty and streamers. Let me quit rambling, keep going. So currencies, all of the fiat currencies are dying. Believe it, don't believe it, it's happening. They're rapidly losing purchasing power. I mean, we look at them on a chart and it's like, yeah, okay, they're going down, they're going up. What's happening in the background is that all of the central banks are rapidly, massively creating more fiat currency. Right now, their major operations, in my opinion, are buying debt. They're buying debt across the duration. Every duration out there, 1 year, 5 year, 10, 30, they're buying all the debt. And not just government debt, they're buying municipal debt, they're buying corporate debt, they're buying all the debt markets in an attempt to keep them from collapsing. The debt markets are trying to collapse. We just got an update. The Japanese bond market, other than the government buying Japanese bonds and the central bank, Japanese central bank, nobody wants Japanese bonds right now. And so anyway, again, in my opinion, we are in a different market environment than we have been in for the last number of years. And so we need to modify our thinking, our analysis of the markets, and obviously our approach to investing, making money in the markets. It's a brave new world. Let's look at the currencies. Before we look at the US dollar, I wanted to look at the euro. So this is euro versus the US dollar in the monthly time frame. Obviously in a downtrend, this is a series of, high, low, lower high, lower low. This is a technical downtrend in the euro in the monthly time frame, potentially at a support level where it may bounce. We can see that lower wick, it's trying to bounce. I don't think it will. Think of what's going on in Europe right now. They're sitting in Germany at least, and probably throughout Europe, they are identifying which industries they're going to shut down this winter because they don't have enough natural gas. And so if we just, you want to talk about the mining sector, what happens to our mining stocks when the government comes out and says, all right, we're going to shut down the mining sector for the winter? And so anyway, I don't see any reason for the euro to strengthen at this point. I would only expect it to continue weakening. And again, the ECB they're madly printing the euro to buy debt, to buy energy, to do all the things that they need to do or think they need to do. And it just, was talking about the euro, one of the things I didn't mention, the central banks do what they call currency swaps, and they don't show up on the books. So, an example, if we look at the U.S. Fed and the ECB, the Fed prints up $500 billion worth of Benjamins, $100 bills, and the EU prints up $500 billion worth of euros. I don't know, I think we still have a 500 euro note. And so, they print up $500 billion worth of those. And then the ECB and the Fed, they swap. And so now the ECB has $500 billion worth of Benjamins, and the US Fed has $500 billion worth of euros. And on their books, nothing has changed. And so they don't show it on their books because, again, I had $500 billion. I still have $500 billion. Nothing has changed. There's nothing for me. Basically it's a wash on the books. And so we don't see it. But in the background, just know that's one of the things the central banks are doing is they're swapping currencies with one another, again, in an effort to stabilize the currencies, stabilize the debt markets. I apologize, I'm at 30 minutes. I really wanted this to be a short update, but again, there's just so much going on right now, folks. And so anyway, I expect the euro is going to continue going lower. The yen, this is the yen in the monthly time frame, just falling apart. I mean, Japan has been, for at least 20 years, been madly printing fiat currency. They are continuing to do so. They're buying their own bonds in an attempt to stabilize their bond market. We can see that the yen just lost what could have been a support level, headed lower. Based on Andrew's pitchfork, the next price target in the yen is way down here. Yen's headed lower. And so as long as the euro and the yen are headed lower, the US dollar index, what we commonly call the US dollar, is going to continue higher. It means, look, the euro's 57% of the basket, the yen is 13% of the basket. That's 70%. So 70% of the currencies in the dollar basket are headed lower, and in my opinion, dramatically lower, which will lead to strength, ongoing strength in the US dollar. I wanted to back out a little bit. This is the monthly chart of the dollar. Wanted to show this is the 120 target. So when you see people talking about 120 in the US dollar, this is what they're referring to. This was back in 2001. The dollar reached just over 121. And so we can see right now we are pushing into resistance. This was this support resistance zone, and we're pushing into that level now. We got a little bit of an upper wick on that candle as price has pulled back, price or the dollar has pulled back from there. We can see bull is hard on in, or MACD, hard into bull mode, heading higher. There's nothing in MACD that suggests that we're topping. Same thing in stochastic. It's pegged at its, not at its max, but at a very high level. No indication in this chart that the dollar is going to top here. In the weekly time frame, similar story. MACD in bull mode, stochastics very high, energy very high. Price has pushed up through. This is the second median line extension of this Andrews pitchfork. Price, or the dollar, has pushed above that level, pulling back currently. Maybe we get a correction here, maybe not. Again, no indication that price or the dollar wants to slow down at this point. Now we're in the daily time frame on the dollar. This is a modified shift pitchfork. We can see the dollar has pushed into that level and currently pulling back. You might say it's like, okay, the dollar's topping. Yeah, well, I would have said that back here on this price bar. What was that, Monday? Yeah, no, maybe that was Friday on the 8th. Yeah, that must have been Friday. I would have said that the dollar was topping right there on Friday, and look what it did. We come into Sunday night or Monday, and bam, there goes the dollar again. And so anyway, I would suggest that the dollar is just going to keep pushing higher here, or the dollar basket. Because again, it's a different world, folks. We have to start being very clear in our language and making a distinction between the US dollar basket, the basket of 6 currencies which make up the dollar index, and the dollar that we carry around in our wallets. The Jacksons and the Benjamins that we carry around in our wallet. They're two different things. The bills that we have in our dollar are in our wallet. Those are fiat That's fiat currency. That's the fiat US dollar. It's not the same thing as the US dollar index. And regardless of how we want to look at it, it's all losing value, purchasing value. The stuff that we're able to trade those dollars for, we're losing purchasing power on a daily basis. And you know, I hate to say it, I suspect we're headed into hyperinflation. My voice is given out. I've been at it for 35 minutes. I'm almost done. Promise. I'm almost done. Apologize for going on so long. There's just so much going on in the financial world right now. This is the 1-year Treasury bill in the monthly time frame. I like this chart because when it goes vertically, I know something's going on. I may not know exactly what's going on, but I know something's going on and it ain't good. And so we can see this is incredible. You know, look at this vertical movement in this price chart. I mean, you can't even talk about that being parabolic. It's just plain vertical. It's going straight up. And so anyway, we don't know exactly what's going on right now, but we know it ain't good based on this one chart. And in my opinion, this chart, this is not topping. This is not peaking. This is the central bank buying up Treasury bills. They're buying up Treasury notes. They're buying up Treasury bonds. They're buying all durations. And again, it's government, it's corporate, it's municipal, it's everything. They're buying debt, trying to stabilize debt markets. They're trying to prevent another 2008. And of course, things have only gotten worse since 2008. It's not going to be another 2008. It's going to be far worse than 2008. And so anyway, this is the only debt chart we're going to look at. I just wanted to keep on everybody's mind that there are dramatic changes happening in the debt markets. This is the interest rate on a 30-year fixed mortgage. Real estate is not going to pull through this unscathed. In the background, the real estate markets are suffering. Listings are climbing. Listings are sitting on the markets. We're not getting the, first day on the market and you got 6 bids or 6 offers and they're all over your asking price. That's not happening anymore. It may be happening in certain pockets. Real estate is very local. And there is also time lag in the real estate markets. The stuff that's in escrow today, pending, it was put into escrow 30 to 60 days ago, and the interest rate, the mortgage rate, was locked not long after that property went into escrow. And so there's a 30 to 60 day lag between the numbers we see in the real estate versus what's really going on today. And so I like looking at this 30-year mortgage rates. All I'm doing is searching Google on that phrase, and it brings up this chart. Look at that, folks, 6.7. So if you want to go out and get a fixed rate mortgage today, it's going to cost you 6.7. Back in January, that would have been 4%. And so I'm veteran, so even I'd go get a VA, it's still at 6.3. And again, that's almost double. Back in January, I could have gotten a mortgage for about half that. Fortunately, I refied back in 2020, so I got a lot lower than that. This is the last thing, and I'm going to go. Look, I'm going to finish in less than 40 minutes. Again, apologize for going so long, folks. What would you like to hear me talk about? I mean, there's so much going on in the financial markets right now. I'm keeping an eye on it all because, I'm an investor. This stuff affects me. I'm doing it for you too. I mean, I want to provide value for you. I want to help you in your understanding of the financial markets, but I do this for me. But I'd like some feedback. What would you like me to talk about? What information can I analyze and attempt to make clear for you these are just some potential topics of some of the things that are going on in the world right now. I'm not really interested in looking at individual mining stocks. I think that's not the place to focus right now. If you're focused on individual mining stocks, you're missing the big picture, in my opinion. There are far bigger things going on. I mean, look, China has stopped. About 4 months ago, they stopped shipping stuff to the Western world. China's not shipping stuff to America anymore, or to Europe, you know. And you want to talk about individual mining stocks? I mean, again, you're focused on the wrong thing. There's a massive collapse going on in China. You know, Evergrande was, you know, $300 billion, and then it's exposing all of the people that bought Evergrande debt, which, you know, it wasn't just China, it was European banks as well, US banks. Collapse of the US dollar, the Belt and Road Initiative, Nigeria, second largest oil producer in OPEC, now selling oil in a yuan denominated bond. Saudi Arabia is talking about doing the same thing. We've got inflation at 9.1%. It's not peaking. So the talking heads right now, they want to tell you, oh, inflation's peaking, it's going to start backing off. No, it is not. They are kidding you. They are lying to you, whether it's out of naivete or they're intentionally speaking a narrative. Inflation is not peaking. In fact, it's just getting started. Let me tone down a little bit. I'm getting wound up again. And so anyway, inflation is going to continue higher. And one of the reasons that is so is because the Fed and the ECB are out there buying all the debt. And they're buying the debt with printed fiat dollars and euros and all the, you know, yen, etc. There is a massive creation of fiat dollars happening right now. They're telling you quantitative tightening. That's BS. They are not tightening. They're printing dollars. They're buying debt. It's massively inflationary, if not hyperinflationary. So anybody that wants to tell you inflation is peaking at this point, they're again, naivete speaking a narrative, one of the two. I mean, this is what's one of many things that's going on in the many energy markets right now. Our government, you know, the people that we elect, if you believe that the elections are legitimate at this point, and you might talk about Dominion voting machines. But anyway, our government is talking about shutting down the entire Permian Basin. It's about 40% of the oil that we mine here or pump here in the United States. 40%. Going to shut down the whole Permian Basin. And you want to tell me that inflation is peaking? So anyway, give me some feedback in the comments. What would you like to hear me talk about? I do my best to dig into any area that you're interested in. There's just so much going on right now. I'm not sure where to focus, other than I'm focusing on the things that affect me personally. And of course, where I am invested, just full disclosure, I put my money into physical silver and gold because I don't know where else to put it. All the other those silver and gold are manipulated too. I was about to say that all of the other markets are manipulated. Yeah, all of the markets are manipulated, including silver and gold. But I don't know where else to put my money at this point. The only thing that I believe is real from a monetary sense is silver and gold. They're tangible items. Gold in particular has acted as money, a store of value, for 2,600 years now. The first gold currency was in 600 BC. That's 2,600 years ago. It was in both China and in Europe. It was about the same time frame in both places. 600 BC, we had our first gold currencies, and that has been a store of value ever since. In my opinion, regardless of what happens in the rest of the financial world, gold and silver will be the last men standing, and I intend to have most of my money in silver and gold. So anyway, I'm done rambling. enjoy the rest of the day, the rest of the week. I'll do another update probably this weekend. Talk to you soon, folks.